Hey, welcome back to the channel, everyone. I'm really glad you're tuning in today because this one is going to be a deep dive, and it's shaping up to be a very technical-driven discussion. If you've been following the markets lately, you know just how much macro events have been influencing individual stocks. And in this video, I want to take you through not just what's happening with Opendoor, but also how the broader market setup is setting the stage for how this stock could perform in the days ahead. This video is for educational and entertainment purposes only. I am not a financial advisor. Nothing in this video should be taken as financial advice, investment advice, or trading advice. Always do your own research and consult with a licensed professional before making any investment decisions. Investing in stocks, especially highly volatile ones like Opendoor, carries significant risks, including the risk of losing your entire investment. But before we get into all of that, we need to step back and run through what's happening in the bigger picture. Why? Because the truth is simple. Macro moves dictate the backdrop, and individual stocks like Opendoor can't escape that gravity. If the overall market is trending strongly up or down, individual names often follow, even if their own fundamentals haven't changed in the short term. So let's look at the calendar for the week. On Tuesday, we've got retail sales data coming out. Retail sales are one of those reports that doesn't always grab headlines, but they're hugely important. They tell us how the American consumer is behaving. And remember, consumer spending accounts for roughly 2/3 of the U.S. economy. If retail sales come in hotter than expected, it means people are still spending despite higher interest rates, sticky inflation, and all the economic uncertainty. That can be bullish for equities because it suggests the economy is holding up. On the flip side, if retail sales are weak, it feeds into the recession narrative, and that tends to put pressure on stocks. Then on Wednesday morning, we'll be getting building permits and housing starts data. Now, this is a data set that often gets overlooked by casual market watchers, but for a company like Opendoor, it's actually critical. The housing market is one of the most rate-sensitive sectors in the economy. When interest rates rise, mortgage costs go up, affordability falls, and demand for housing slows down. When rates fall, affordability improves, and more people can enter the market. For Opendoor, which operates at the intersection of technology and residential real estate, the health of the housing market directly impacts transaction volumes, margins, and investor sentiment. So pay close attention to this report, because even if it doesn't make front-page news, it can quietly shift the mood on real estate-related stocks. But here's the big one, the event everyone on Wall Street is watching, the Federal Reserve's meeting on Wednesday afternoon. This is where we get not only the rate decision, but also the press conference with Fed Chair Jerome Powell. At this point, it's fair to assume we're going to see a 25 basis point cut. That's been telegraphed for weeks. Markets are already pricing this in with a 93.4% probability. In other words, the actual act of cutting rates this September isn't going to surprise anyone. So you might ask, if everyone knows the cut is coming, why does this meeting matter? And the answer is simple, because it's not about the cut itself, it's about what Powell says next. Now here's where things get interesting. The September cut is basically a done deal. What the market really cares about is the path forward, specifically the October 29th meeting. Right now, futures markets are assigning a 79% chance of another 25 basis point cut in October and even a 5.5% chance of a larger 50 basis point cut. Neither of those scenarios has been priced into stocks yet. That means the real volatility this week hinges not on the September move, but on Powell's tone and guidance about the future. If Powell hints that more cuts are on the table in October, especially if he suggests the Fed is willing to be aggressive, then you could see equities rip higher. Risk assets like growth stocks, speculative names, and even crypto could all rally sharply. If Powell, however, plays it safe and stays vague, if he says something along the lines of, "We'll remain data dependent" without committing to anything concrete, then the market could actually sell off in disappointment. This is why I keep stressing that this week isn't about the September cut. That's a given. This week is about Powell's words, his tone, and his forward guidance. One sentence in that press conference can swing trillions of dollars in capital. there's another piece of this puzzle that I want to highlight: the massive amount of money currently sitting in money market funds. Right now, we're talking about $7.3 trillion, an all-time high. That's an incredible amount of capital parked in safe assets, earning yields thanks to the higher rate environment. Some analysts argue that once the Fed starts cutting rates, a portion of that cash will rotate out of money markets and back into equities and crypto. The idea is that if yields fall, money market funds become less attractive, and investors go hunting for returns elsewhere. Now, do I think this rotation will happen? To a degree, yes, but I also want to temper expectations here. I don't think it will be as dramatic or immediate as some people on social media are making it sound. Unless Powell signals not just one, but multiple cuts ahead, I think a lot of that $7.3 trillion will stay parked. However, if Powell does open the door to a series of cuts, then yes, you could see meaningful flows of capital moving back into equities, which could provide a strong tailwind for speculative growth names like Opendoor. So again, Powell's messaging is the make or break factor this week. All right, let's shift gears back to Opendoor specifically. There's been a lot of chatter about the CEO's pay package kicking in on Monday. Now, technically, this is a catalyst, but I don't see it as something that's going to move the stock in a major way. It's already been priced in. Investors know about it. The real story isn't about executive compensation. It's about how Wall Street views this company right now. Is Opendoor just another meme stock being pumped and dumped by retail traders? Or is it a serious, disruptive business with long-term potential in the real estate market? That's the debate that's fueling volatility. And until we get clarity, probably in the next earnings report around November 6th, this back and forth is going to continue. Let's get into some numbers. Short interest in Opendoor currently sits at 24.35% of the free float, which equates to about 160 million shares. That's massive. Anytime you see short interest above 20%, you know there's potential for fireworks. Hedge funds have been heavily involved here, which is why we saw Opendoor drop late last week. Shorts returned about 4.43 million shares after some big institutional selling, but they've remained active. And here's the key dynamic. If Opendoor starts to climb, shorts are going to feel pressure. When shorts feel pressure, they cover. When they cover, it adds more buying momentum, which can send the stock higher in a hurry. That's why volatility is so high right now. To add even more fuel to the fire, this week is a quad witching week. That's when stock index futures, stock index options, stock options, and single stock futures all expire at the same time. Historically, quad witching weeks see some of the biggest swings of the quarter, both up and down. For day traders and swing traders, this is a golden setup. Big opportunities, sharp moves, and plenty of action. But for long-term investors, it often just looks like noise. The key is knowing which category you fall into. If you're long-term, don't get shaken out by quad witching volatility. If you're short-term, buckle up because this is your week. So, where are traders positioning right now? On the bullish side, people are calling for Opendoor to hold in the $10 to $11 range by the end of the week. On the bearish side, expectations are for a pullback towards $7 to $7.50. With Friday's close at 9:07, we're right in the middle of that battleground. Looking at the options market, there's a ton of open interest at strike prices $9 and below. We're talking 21,000 contracts at $9, 10,000 contracts at $8.50, and 26,000 contracts at $8. That kind of setup has the potential to spark a gamma squeeze if market makers need to hedge their exposure. And then there are the block trades we've seen. 2.2 million, 2.3 million, 1.1 million, and even a massive 13.7 million block. These big trades show that institutions are active, but even with those, the open interest buildup hasn't been fully offset. With Opendoor sitting at 907 cents, the stock is trading between its pivot point and S1 support. Support levels 828, 750, and 728. Resistance levels 953, 1078, 1156, and then a stronger target up at 1281. Here's my personal view. I think we may test S1 or even S2 support this week before building momentum again. But if Powell hints at October cuts, that could change everything. That kind of news could be the spark that sends us ripping back higher. For gap fill traders, there are multiple unfilled gaps on the chart, with heavy buying historically resuming around 7.17 cents and below. So don't be shocked if the stock consolidates downward before making another move higher. And remember, consolidation isn't bad. In fact, it's healthy. It builds stronger support levels that can sustain the next leg up. So what's the outlook? In the near term, expect heavy back and forth. Volatility is going to dominate this week, especially with quad witching and the Fed meeting on deck. Don't be surprised if we retest lower supports before gaining steam. In the longer term, the real question is how Wall Street chooses to categorize Opendoor. If it's treated as a meme stock, expect wild swings in volatility. If it's treated as a legitimate disruptor, then earnings in November will be the real test. Until then, we're stuck in speculation mode. To really understand why the Fed meeting is such a big deal, we have to zoom out. Over the last 2 years, interest rates have gone from near zero to the highest levels we've seen in decades. The Fed raised rates aggressively to combat inflation, and those hikes sent shockwaves through nearly every corner of the market. Housing cooled dramatically, tech stocks got crushed in 2022, crypto went into a deep winter, and borrowing costs for consumers and businesses shot up. Now, as the Fed finally pivots toward cutting, the stakes are enormous. Markets live and breathe on expectations. It's not just the actual cut that matters, it's what investors believe will happen next. Think of it like this. If you're playing chess, you're not just reacting to the last move, you're trying to anticipate the next 3 moves. Investors are doing the same thing with Powell's words. If Powell signals that cuts will keep coming, then risk assets suddenly become far more attractive. Companies like Opendoor, which are sensitive to mortgage rates, could see a wave of optimism. Cheaper borrowing costs mean more home buyers, more transactions, and potentially better margins for companies operating in the real estate sector. On the other hand, if Powell hints that this September cut is just a one and done, or if he sounds worried about inflation flaring back up, then the market might brace for disappointment. That's why traders are on edge, because the path forward could either unleash a rally or slam the brakes. It's worth pausing here and looking at some historical context, because markets don't move in a vacuum. Back in 2019, for example, the Fed started cutting rates after a series of hikes. The housing market perked up almost immediately. Home builders rallied, mortgage applications climbed, and stocks tied to real estate saw a noticeable bump. Why? Because lower rates restore affordability, and housing is all about affordability. But there's another side to this story. Sometimes rate cuts signal weakness, that the Fed sees trouble in the economy. In those cases, cuts don't always spark rallies. Instead, they can trigger fear. Think back to 2007 and 2008. The Fed was cutting aggressively, but housing stocks were still collapsing because the underlying fundamentals were crumbling. So the key question for investors right now is this: are these cuts being made from a position of strength as a way to fine-tune the economy, or are they being made because the Fed is worried about cracks beneath the surface? That's the lens you need to use when thinking about Opendoor and the housing sector in general. Now let's bring this back to Opendoor. Unlike traditional home builders or REITs, Opendoor sits in a unique space. It's what you'd call an iBuyer, a company that uses technology and data to buy and sell homes quickly. The idea is to bring liquidity to what has traditionally been a very illiquid market. In theory, Opendoor's model thrives when transactions are happening quickly. If mortgage rates are high and people aren't moving, then Opendoor struggles because volume dries up. But if mortgage rates come down and affordability improves, Opendoor could suddenly see a surge in activity. That's why interest rates matter so much here. It's not just a macro backdrop, it directly influences the core of their business model. But here's the challenge. Opendoor also has to manage risk. They're holding inventory, actual homes on their balance sheet. If housing prices fall, that inventory loses value. If housing prices rise, they can capture gains. This makes Opendoor not just a tech stock, but in many ways a leveraged play on the housing market itself. That's why investors treat it with such caution and why volatility is so extreme. One of the biggest narratives right now is how Wall Street classifies Opendoor. Is it a meme stock like AMC or GameStop, driven by retail traders and social media hype? Or is it a legitimate disruptor in one of the largest industries in the world? The answer might be both. On one hand, Opendoor clearly has meme-like qualities. The high short interest, the cult following, the sudden spikes in volume, all of these are hallmarks of meme stocks. On the other hand, the company actually has a real business model, real revenues, and a strategy to disrupt real estate. That makes it very different from some of the meme names that had weak or no underlying businesses. This tension between meme speculation and long-term fundamentals is what's fueling the volatility. Bulls see Opendoor as the next great disruptor, a company that could reshape the housing market the way Uber reshaped transportation. Bears see it as an overhyped cash-burning experiment that's too exposed to housing downturns. Until earnings give us clarity in November, that tug-of-war is going to continue. We touched on short interest earlier, but it's worth expanding. With short interest at 24.35% of the float, that means nearly a quarter of all shares available for trading are being bet against. That's enormous. To put it in perspective, anything above 10% is considered high. At 20% and above, you're in squeeze territory. Why does this matter? Because short interest is like dry tinder. If the stock starts rising, shorts are forced to buy back shares to cover their positions. That buying can fuel even more upward momentum, creating what we call a short squeeze. And when you layer in options activity and potential gamma squeezes, you've got the ingredients for explosive moves. Now, this doesn't mean a squeeze is guaranteed. Plenty of heavily shorted stocks grind lower without ever squeezing. But it does mean volatility is going to be elevated, and traders need to be prepared for sharp moves in both directions. This brings us to an important distinction. Technical traders and long-term investors are playing two very different games with Opendoor right now. For traders, the game is all about support and resistance levels, momentum, and short-term catalysts. You're looking at whether the stock holds above $8.28 or breaks resistance at $10.78. You're paying attention to options flows and block trades. You're trying to capture swings over days or weeks. For investors, the game is about whether you believe in Opendoor's business model over the next 5 to 10 years. Do you believe iBuying can become profitable? Do you believe housing transactions will become more digital? Do you believe Opendoor can survive downturns and thrive in upcycles? If the answer is yes, then you're looking at dips as opportunities. If the answer is no, then you're avoiding the stock altogether. Both approaches are valid, but it's crucial not to confuse the two. Traders can get burned trying to invest in a volatile name without risk management. Investors can get shaken out if they're watching minute-by-minute price action. Know which camp you're in before you buy. Quad witching deserves a deeper look too, because it's one of those terms you hear thrown around but don't always get explained. Basically, it's when 4 types of derivatives contracts expire at the same time. Stock index futures, stock index options, stock options, and single stock futures. When this happens, market makers, hedge funds, and institutions are all rebalancing their positions. That leads to unusual spikes in volume, sharp moves, and often unpredictable trading patterns. For a stock like Opendoor, which already has high short interest and heavy options activity, quad witching can act like lighter fluid on a campfire. It can take a small spark and turn it into a roaring blaze. This doesn't mean Opendoor will definitely explode higher this week. It could just as easily swing down. What it does mean is that the probability of outsized moves is higher. Traders should expect the unexpected. Let's step back for a moment from all the short-term noise and ask the bigger question: what is Opendoor trying to do in the long run? Because that's what will ultimately determine whether this stock has staying power. Opendoor's vision is to make buying and selling a home as easy as trading stocks. Think about how clunky the traditional real estate process is. Agents, paperwork, inspections, negotiations, closing delays. Opendoor wants to streamline all of that with data-driven pricing, instant offers, and a more digital process. If they succeed, they could transform an industry worth trillions of dollars. The U.S. housing market alone is massive. Even capturing a small slice of it could make Opendoor a giant. But execution is everything. The model only works if they can manage inventory risk, operate efficiently, and convince consumers that their way is better. That's why some investors see Opendoor as a high-risk, high-reward play. The upside is huge, but the risks are equally real. Looking ahead, the next major fundamental catalyst for Opendoor is earnings, estimated around November 6th. That's when we'll get a clearer picture of how the company is navigating this environment. Are transaction volumes picking up? Are margins improving? Is cash burn under control? These are the questions analysts and investors will want answered. Until then, expect speculation, volatility, and noise to dominate. The story will be written by traders, not fundamentals. But once earnings land, the narrative could shift dramatically, for better or worse. So let's bring it back to the present. Right now, we're looking at a stock that closed Friday at 9.07 cents, sitting between strong support and resistance levels. We've got macro events this week that could send ripples across the market. We've got quad witching to amplify volatility. We've got short interest that could fuel squeezes. And we've got an earnings report in November that could redefine the long-term story. So here's the big question for you. How are you playing it? Are you buying the dip if Opendoor falls into the 720 to 750 range? Are you holding steady and waiting for earnings? Or are you sitting on the sidelines, content to watch the show? Whatever your approach, remember this. Volatility is both an opportunity and a danger. Respect it, manage your risk, and know your strategy. If you found value in this deep dive, make sure you hit the like button, subscribe to the channel, and turn on notifications so you never miss a future update. Drop your thoughts in the comments. I really want to hear your perspective on how you're approaching Opendoor this week and what you think Powell will signal at the Fed meeting.